Welcome back to Trading 360. I'm Diane King Hall, live from the floor of the New York Stock Exchange. Joining us now is Russell Hackmann, president of Hackmann Wealth Partners and author of Wall Street is Not Your Friend. He'll tell us a little bit more about why he sees it that way and what Wall Street doesn't want you to know. But Russell, thank you so much for joining us today. Let's start out with, before we dive into, kind of some of the things that you want investors to pay attention to with regard to how Wall Street operates, let's talk about just big picture, where we are with equities this year.
Right.
There's been, quite the recovery, but the S&P 500 now a little bit higher year to date. What's your outlook when you think about the second half of this year?
Well, I think there's still a lot of wild cards. Right now, clearly the Trump administration is doing whatever they can to be supportive of the markets. At the same time, when you look at what's happened in Iran, the wild cards around inflation, still a lot of wild cards around tariffs. I'm cautious. I call it cautiously optimistic, right? You're now getting some movement in long-term bond prices down, and maybe the Fed's going to cut. I'm sure you've been talking about that. That's usually supportive of equities, and that's why we're positive.
Okay. Let's talk a little bit about the potential for reigniting inflation. We'd seen a big pop in oil prices over the weekend. That's since come back, and now oil is a little bit lower, but still around $73 a barrel, which is significantly higher than what we'd seen about a month ago, essentially. Like, we were in this range from 60 to 65 for a while, and there was this expectation we would be in a range between 55 to 65. I liked the prices at the pump when we were in that 55 to $65 range. This weekend when I filled up, it was a little bit higher for pump prices. What are you expecting in terms of the spillover effect when it comes to inflation?
Well, I think if oil stays in this range, 73, 75, that would be great. I think, having watched the Middle East for a long time, usually, there's knock-on effects to what's happened sort of militarily and politically that, may be unexpected. So if oil were to spike, sort of talking about potential unrest in the Strait of Hormuz or other types of militias acting or things like that, that could cause an oil spike above $100. And I think that'd be a negative. So we're going to keep, we're hoping that this military action won't spill over and get worse. But unfortunately, sometimes that's been too much to hope for.
Yes, and because, it seems like in terms of how the market is pricing the risk of wider escalation, it seems like there's, low risk of that. But let me ask you about what you're paying attention to within the fixed income sector. What worries you there?
Well, there's been a sort of pretty consistent drumbeat from the likes of Jamie Dimon talking about, hey, the bond market's going to crack someday. At the same time, over the last, even this morning, right, you've got the 10-year down to about 4.3% or so. And so, things are behaving appropriately. We're very concerned about the long-term effects of the budget deficit, and our advice to retail clients is really mostly to stay out of fixed income. That even without great inflation, just the supply-demand dynamic around bonds, if you're borrowing $1.9 trillion a year, right, that's a lot of supply of bonds, and the potential is that yields go higher.
I think I've asked you a similar question to what I'm about to ask you before. Why is Wall Street not your friend? That's your title.
Yeah, I wrote this book, Wall Street is Not Your Friend. And it's, as part of my wealth management business. And, in general, the message that we're spreading is a couple things. One is that the traditional stock bond mix, 60-40, 70-30, isn't great if bonds are not great. And we saw in 2022, both stocks and bonds really didn't do well, right? And I think there's concern about that in future downturns that I have. I have concern about that. The other major concern that I have, and I've seen because we see clients from all kinds of the different big box Wall Street firms that come in to see us, is we look in their portfolios, and one of the reasons I say Wall Street is not your friend is that in many cases they may be being charged 2 or 3% while at the same time not knowing it. So Wall Street is really good at hiding fees, right? And that's a big message of ours, you know?
Let me ask you your advice to, I want to break this down by, say, demographics or timeline. Let's say you have clients who are 10 to 15 years, 10 or more years out from retirement. What's your advice then in positioning to them, especially if, and you're not the first person I've heard this from, that the 64-40 portfolio is dead?
Right, right. We like particularly in like workplace plans, and we see like, in my opinion, these target date funds that have emerged and that are mandated or basically the default option.
Like the target date
I
funds?
don't.
Okay,
and a lot of the 401k plans. And I've seen, kids of clients, 20s, 30s, who have like a 60-40 bond mix, and to me that's just nutty, right? If you're 20, 30, 40, you should be 100% stocks, and you should be ignoring what's going on day to day. And then it gets different when you get into the retirement red zone, where your 5 years or less are actually in retirement. In that instance, you got to be a lot more careful about risk management. And bonds, by the way, again, in my opinion, not the safe place to be.
So retirement red zone is 5 years until retirement.
Exactly, and then in retirement.
Yeah, and then in retirement. So if you're in the retirement red zone, you still don't love a larger mix of bonds in there?
I don't. I think there's other types of safe assets that you can buy. For example, the U.S. 10-year's at 4.30, but so is 3 to 6 month T-bills. Those are at 4.25%. I'd rather buy those than a 10-year Treasury that can go down in value, right?
It's a shorter term.
Yeah, and there's other, what you might call safe assets that have principal protection, for example. It's a longer story, but I like those better than bonds.
How do you feel about gold?
To me, gold it can be like a trade, but isn't something we use in our business. I think people forget that bond in the early 80s, or gold in the early 80s, was at about $800 an ounce, right? Now it's $3,300 an ounce, or it depends on the day of the week. That's not a great return over time, and you saw decades where gold didn't move at all. So I'm not a big gold bug.
But as a safe haven, though, because that's how people look at it.
Right.
Yeah.
I think as a few percent of your portfolio, you could do that. I mean, we don't do that in our portfolios, but I don't think that's unreasonable. I don't think it's, anything. It's a little bit like crypto to me. Not to say gold and crypto are the same, but like you don't want too much of your portfolio in those kind of assets.
All right. Thank you, Russell. Appreciate your
nice
time.
To see you again.
It's good to see you,
Thank you
too.
very much.
That's Russell Hackmann, president of Hackmann Wealth Partners and author of Wall Street is Not Your Friend. Thank you. Or thanks to Russell.
Thanks.